securities market are subject to market risks. Read all the related documents carefully before investing.
Hello, good afternoon, everyone. Day 2 of Super 6 in association with Kotak Securities. This is turning out to be a fantastic learning series for all of us. Yesterday, we heard 3 amazing speakers giving their strategies to us, and today we heard in the morning Gomti. What an amazing person. What a person who has so much of depth in the knowledge of CPR. And now we are going to have a session with IT Jagan. IT Jagan is one of my favorite people who have come from nowhere to now he is somewhere, and I wish he will go everywhere because he is someone who is actually doing great and genuine work in the market. Let me invite IT Jagan. IT Jagan. Jagan,
Hi Vivek,
are you
how are
there?
you?
Jagan? Very good. Good afternoon. How are you doing?
Very good. How are you doing? Yeah.
Good to see you. Good to see you. And first of all, congratulations for your new office. I hope
Thank you.
you grow leaps and bounds and create more offices across the globe, not just in India.
Sure. Thank
You
you.
know that I'm one of your fans, right?
Yeah, correct.
Right. Friends, before I request Jagan to start this, I want to inform one thing that people who have taken the Super 6 combo, I have a special gift for you. There will be a lottery, and one person will be selected, a purely lottery. There is no preference, etc. It's going to be lottery, and any one person who will be selected will be allowed to go to his favorite expert's place and spend some time with the expert, and that will be done totally sponsored by us. No cost to be paid by you or flight, etc. If there is any cost, we will sponsor that. So Jagan, first of all, thank you so much for accepting this and agreeing to spend that quality time with my learner. Thank you so much.
Thank you. Thank you so
So
much
I'm
for
looking
inviting.
forward to your session. Sorry, you were
Sure.
saying something?
Thanks for your invite. That's what I said. Yeah.
Thank you so much, Jagan. I mean, I can't thank you enough. So I'm looking forward to this learning session from you again. So without much ado, let me just invite you to take the session, and I'm going to be offline with you for coming 2 hours at least. I'm sure that you give your best. Thank you.
Thank you.
Looking forward to it. Bye-bye.
Sure.
We can see your screen.
Yeah, right. So perfect.
Perfect. You're all set. All
Yeah.
set, guys. I hope you have your pen and paper ready, and feel free to keep note down your questions, and don't worry about answers of a question. Even if you are not able to answer, Jagan is very kind person. He will answer and give post as well.
Right. Guys, good afternoon to everyone. So the session is going to be on butterfly option strategy for regular income. So we are going to do this one in Bank Nifty weekly. Okay, so week on week, we are going to get a regular income, and all this of risk defense strategy is very famous in US, but it is not so famous in India. So this session will teach you uh, risk defense strategy, and butterfly is one of them. With that, actually, how your retail people can get monthly income week on week. So it's going to be so simple. So let me go with the agenda. Right, so guys, let me start with the this is agenda, trading agenda. The first, let me start actually option selling, why and what is the myth, and most people where exactly they are doing the mistake in option selling, right? So people still think that actually option selling is all about short strangle and short shuttle, but it is not really so. And short strangle or short shuttle, I never do it after 2018. So I'm doing only risk defense strategy. uh, that's what I'm going to explain as part of butterfly. Not only there are many strategies, but butterfly is my pet strategies because we are going to hold this trade only for one overnight. So if you see my Twitter space, right? So Twitter, every time I used to post this my screenshot, how much profit I made in positional, and what is the strike price I sold, and what is the quantity I did, and what is the basket size. So hereafter, after this session, you can somewhat relate that actually how IT Jagan is doing this butterfly strategy in real term. So about risk defense strategy, why it is important, and market analysis or market outline, how I take every day And because butterfly strategy, it is not a non-directional strategy. I have directional strategy as well as a non-directional strategy. So based on the market analysis and market outline, how we are going to do the market analysis. So based on YI or PCR and max pain, all these things I'll be explaining as part of this training, so that you will come to know for tomorrow view what is the butterfly we are going to take. It can be a bullish butterfly, it can be a bearish butterfly, it can be a range bound butterfly. So how we are going to take. So that's the third item. Fourth item is designing a strategy. It is very important because many people are having a how do I say that? It's a fixed strategy. So they will say 1:2, 2:1. So that is a very famous term in butterfly. With the iron contour, they always do 1:1. With the calendar spread, actually, they always do 1:1. So this butterfly strategy, it is not an orthodox strategy. It is an unorthodox strategy. So sometimes it is going to be 1:5:5. Sometimes it is going to be 1:4:4. For new people, you may not get actually what is 1:5:5, but while I do this presentation, by end of the session, you will clearly come to know what is all this 1:5:5 and all these things you will come to know. So designing a strategy is very important because we are dealing with options, and option prices are asynchronous. Asynchronous in the sense, sometimes you should do with 1:5:4, sometimes you should do 1:5:5. See, this ratio depends on the option premium. The option premium depends on multiple factors like volatility, dividend, all these factors. So I'm going to say to you how we need to design the butterfly strategy for a given a condition, for a given a market view, for a given a capital. So your capital may be 10 lakhs, your capital may be 5 lakhs, the VIX may be 15, the VIX may be 20. So on what volatility, what type of butterfly you should do, what is the, how do you define the max risk? So all these factors will come under designing a strategy. And fifth one, butterfly trading system. So here is very important. So whether you're going to do bullish or bearish, and what is the max risk you're going to do, that's what I'm going to explain in a butterfly trading system, right? And risk management. So what is the risk we should take at the maximum, especially the black span event? If you take any option selling strategy, right? So mostly you will get total profit, and when there is a black span event, actually sometimes the profit whatever you gained in a year will get wiped out. So how do we control it? How do we manage the risk? How do we know what is our notional value? See, all these things I will explain as part of this risk management. Even in worst cases, say for example, market is taking a 10% gap down, three in a row. Okay, so next day gap down, 10% low, next day is a 10% low, next day 10% low. In such a cases also, what is the max risk you are going to get as part of this butterfly strategy? So that's what I'm going to teach you as part of risk management, because if you lose all your capital, then it is impossible to get your capital back, right? So risk management is very important. So as part of butterfly, there is a notional value which I will talk. Okay. And position sizing is somewhat connected with the risk management, because butterfly strategy, you are not supposed to do full capital into butterfly. You are supposed to do only 50% or 25% of the capital, because it is a high risk and high reward strategy. So the only way is actually you're going to put your position size is less, because you're going to carry the overnight positions. My advice is maybe 40% of your capital you can put into this butterfly, not into 100%, because any risk defense strategy you carry for overnight, if there is a black span event, if there is a series of black span event, there is a chance that your capital will be wiped out. So this position size I will explain in detail later. But position size right now, there are two portions, right? So the margin allocated for butterfly is different and the capital is different. So I explain for how much capital, what is the position size you should take for butterfly. So the simple things, this is the agenda, and this I will be explaining throughout the session. And live example I will show you. So all kind of butterfly. So it can be a put butterfly, it can be a call butterfly, it can be a double butterfly. So for the current market situation, how we are going to take this butterfly and how we are going to close this one. So we'll explain in detail. So this is the agenda. If you have any question, you can put, right? So guys, What is the edge in option selling? So you all know that if you are referring to my YouTube videos or social media, the reason why I came to option selling, because big boys started selling option, and that is the reason why I started selling option. It's not for time decay, it is not for Greeks, it is not for adjustment, it is not for management. It is purely because big people are selling options, and that is the reason why I came to option selling. And many of the people I meet in social media or at my office, most people are retail people who are having less than 5 lakhs, and they have an intention that they have a feeling that this option selling is only for big people, not for a retail people. But it is not really so, because when I enter into the market, I had only 3 lakhs in my hands, but I was doing only the risk defense strategy at the start. Then I started doing a short strangle or short seller. That is a different game. The point what I'm trying to say is option selling is not meant for big boys. Option selling with the risk defined can be done for big boys, can be done for retail people. The difference is the rate on investment, rate on the rate, the ROI you are expecting out of the option selling is the key. So guys, if you are having 2 lakhs, 1 lakh also you can do with the USD INR. If you have more than 3 lakhs, you can do with the Nifty or Bank Nifty. So every time you're going to get the decay. That is the advantage of option selling. So option selling is the default, edge is the time decay. I used to say this to many people: when somebody is making profit in option buy, they can always raise the collar. When somebody is making money in futures, they can always raise the collar. But if you are really making money out of option selling, you should not raise the collar, because the money you are getting in long run is a time decay. It is not your directional edge. It is mainly on time decay. And that is the reason why most option selling methods or strategies are having more than 70% success rate. Anything you take in trading world, actually the success rate is close to 33% or 30% option buy or future. The only instrument wherein the success rate is very high is the option selling. For a new retail people, I would advise to do this option selling strategy, because he will get very comfort zone with option selling, because most of the time you're going to make a profit. Guys, it's historically proven that the win rate for option selling by default it is 80%. By default, even for this butterfly, whatever I'm going to explain, the success rate is 80%. Then you may ask the question, again, when I make loss, I'm going to make a big loss, right? So how do I going to recover it? Guys, for black swan event, I have a hedging system wherein in a black swan event you don't make a loss at all. Only some portions actually we should do the adjustments, but for this strategy you don't need to do any adjustments. Just you need to look at the market view, how much capital you have, and what is the strike price you are going to do, and how many lots you are going to do, what is the max risk you can define, and then you should take a trade. And next day morning 9:25, you don't need to do any adjustments. Just book your profit or book your loss. That's it. And 80% of the time you're going to make a profit. So the simple strategy. So in these strategies there is no need to do adjustments, because you're going to get into this strategy by 3:20 p.m. and next day morning 9:25 actually you are going to exit. So only 20% of the time you're going to be loss. That loss is going to be very minimal. I will show you in detail with the payoff diagram later. So right now, for the time being, whatever you are going to do butterfly, there are two things we are going to capture. One is directional of the market, we are going to capture little, and second is actually the time decay. So the default edge in the butterfly is a time decay, and next edge is a direction. So these are the two things we are going to capture with butterfly system. And the myth about option selling, that people say actually naked selling, option selling is risk. All the money, whatever you have gained, actually you are going to lose in one day. I'd seen people who had been making money for 10 years, 20 years, right? So, but for Corona, uh, uh, what they did actually, they lost all the money. They lost all the money. And just because they were doing a naked option selling, and because many people are still believing that actually option selling is all about um, short strangle and short straddle. We can always adjust your positions and then make profit, but it is not really so, guys. If you are into naked option selling, I would say that you should put only 25% of your capital into the naked selling, not more than that. But otherwise, learn these risk defense strategies slowly, because this risk defense strategy, if you are able to make 3% per month, right, so consistently, this strategy you can teach to your son, you can teach your grandson, and you can take it forward throughout your career, throughout your life, throughout your family. So always make sure that actually you do only with the risk defense strategy. And 1 year before, if somebody is doing the risk undefense strategy, I would, but right now, if you are doing risk undefense strategy, I would say that it is not a wise decision, because previously there was no margin benefit available for a risk defense strategy. Okay, so right now SEBI is giving the SEBI is giving the margin benefit for risk defense strategy. I don't see any reason for doing a risk and defense strategy. So always stick to risk defense strategy, out of which the one strategy I'm going to teach you here today is a butterfly strategy where the risk is defense. So very simple. So return is too less. That's what people say. I would say that you get chota return every day, and in end of the month you get pada return. So that's what I had seen, because in my opinion, right? So if you have a 3% return expectation with the option selling, and end of the month actually you will get 4%, 5%. So that is my experience in the last 7 years. So for this year, my return is close to 66%. So if I had been doing only this strategy, I would be getting more than 50% per annum. How? Because every day you're going to get chota return, the return is going to be less, and that is the reason why most people are missing this return. So with the trend following or option buy, you getting double or triple in a trade. But in option selling, you get chota return. It is that's a small return. At the end of the day, you are going to get a huge return. So end of the month, you're going to get a huge return. So the cumulative return, you can get it with the butterfly is, I would say that more than 40% you will get per annum. So that 40% return is a big return in stock market. Even a directional player, even a Warren Buffett have not achieved this return. So return is not too less. It may be less per a day, but it is going to be very huge for a year. So return is always high with any risk defense strategy. So limited profit, I used to say this, guys, a limited profit is always good for health. And one sec, guys, limited profit is always good for health. So do not look for unlimited profit always. So first you try to make a limited profit, then let's concentrate on unlimited profit. Okay. So this one, actually many people are thinking that actually we need a very special software, high skills, talent to analyze the market. As the Greeks we need some sophisticated software, we need some inbuilt skills in our brain to make money in a stock market. I would say a big no. So everything, so say for example, out of market, out of premium, out of options, if you look at the price, most technical people, right? So most big people are concentrating only on the price. So likewise, if you are into option selling, if you are into option trading, your the main core element, the main core element is going to be your premium. So you can, if you're able to analyze the premium, then you don't need any Greek, you don't need any other software. So I would say it's a big no. From the day one, I'm not using Greeks and I'm not using any Greek element. I'm using only the premium as a reference for my option trading. It could be any strategy. It could be short strangle, short straddle, or iron condor, or butterfly, or calendar spread. The only the input is going to be the premium. That's it. Very simple. So using this premium, you can design any strategy, because all the technical items, whatever you're seeing, right? So if you take the price, people say RSA, MACD, all these indicators are derived from the price. So likewise, Greeks, delta, gamma, all these terms are derived from the premium. I don't mean that Greek will not work. What I mean is, actually, if you are looking only the premium, you don't need to worry about the Greek. So that's what I'm trying to say. Only talk to the premium. So how Ramanujam used to talk with the numbers, how Jesse Livermore used to talk with the price, the same way if you're an option trader, you're going to talk with the premium. That's it. So you'll get the results on time. So as I said before, I had seen only big boy can do. No, with the people with the 3 lakh capital can also do this option selling with the risk defined manner, because I had done it before. So don't have a mindset that actually to know, to do any option selling strategy, we need a bigger capital, more than 10 lakhs, more than 15 lakhs, more than 20 lakhs. So you don't need to worry about the capital. The mindset you should tune to uh, uh, only the ROI. So that is the only expectation. So far, whatever I covered, so never ever sell a naked options because you are going to get wiped out. Number one, always stick to good return. You are going to get 40% return, and if you are not happy with the 40% return per annum, then nobody can help you in stock market, even with the directional play. And second thing, don't think that actually it is only for big boys. So retail people also can do this one. I used to say this one. Even you have a 5 lakhs, your return expectation is 3% or 4%, then you are a big boy. If you are a big boy and you are expecting 10% per month, okay, so you are having, say for example, 100 crore and you are expecting 10% per month, I would say that you are a retail. So it is not the capital that decides whether you are a retail or big boy. The attitude with which actually you trade, it decides actually whether it is a big boy or retail. So very simple terms. Guys, with that, actually, let's go into the F&O data analysis. So we'll come to know. So before taking any view, right? So before taking anything, right? So first thing we should do the analysis, market analysis. So market is bullish or bearish, and based on which we are going to take a decision. So in Corona fall, if you are doing any butterfly straight away, then you are going to make a loss, right? In bullish market, if you are going to do a call butterfly, then you are going to make a huge loss. So you should know the directions, and based on the direction you should do, because then you may ask the question, Jagan, you are doing some non-directional strategy, right? So iron condor or short shuttle, that's all, those are all non-directional strategy, right? So you can do all kind of non-directional strategies in monthly, guys. When it comes to weekly, right? So once you start selling weekly, you have to make sure that you are most of the time you are directional. If you are trying to do non-directional with the weekly, then you are going to get a huge loss, because the risk and reward ratio, the risk and reward is huge with the weekly options, because the premium can go from 10 to 100 within few seconds. Okay, from 100 to 10 it can come to from 100 to 10 also it can come in few seconds. So both are possible with weekly options. That is not possible with the monthly option. So when you play weekly options, make sure that you need to have a market directions, and based on which actually you should take a trade. Otherwise you may incur a huge loss, or you may incur a huge drawdown. So it is better to take a market view. So to take a market view, there are two options. Number one option, you are going to take a price. Number two options, you are going to analyze the OI, so open interest. So that's what we are going to do right now. So we are not going to analyze the price, we are going to analyze the open interest. So hang on, guys, let me see anybody is asking the question right now. Guys, okay. So if you have any questions, you can always put here so that I'll be able to answer the questions as well. So super. So there are three elements which I will put here. Okay, so future positions and then max pain and put call ratio, three items. So based on which I'm going to take a view, market view, whether the market is bullish or bearish or range bound. So accordingly, I'm going to take a butterfly. So first thing is analyze the market. Second thing is design a butterfly strategy. Third thing is risk management, and fourth one is how to exit your position. So good. Okay. So let me explain the future positions right now. So you're able to see my screen, Excel. Okay. So now going to analyze the future. So the next one is max pain, and the next one is PCR. Three elements we are going to check it. 1, 2, 3. Right. Okay. And future, let me explain. So you look at the future. Okay. So how you need to analyze? Right now the market is market view. Price, open interest, I would say that this is market view. Okay. When the price is up, which means that the price is going up, okay? Nifty or bank nifty is going up, okay? So this is underlying. Okay? So nifty. Let me put the bank nifty, okay, to understand. So it means that the price is going up, okay, and open interest is also going up. It means that everybody is betting on, which means that everybody is purchasing the nifty future, bank nifty futures. This I refer to future. This I refer to future. So when I say the price is going up, say for example, bank nifty is moving from 38,000 to 38,100 at end of the day. So from morning to evening, whether it is a green candle or up candle. So that's what you're going to check it. And OA is up minimum 10%. Very important. Minimum 10%. So this open interest, you can always check in a money control website. So you can go here, block data, you can go to money control website. So you can check it here. See, this open interest is coming down. The open interest is not increasing. So you can check it, the price is up here, but the open interest is coming down. Okay. And you need to also check the combination of current month and next month. Okay. Even with the bank nifty, the price is a little up, but open interest is not so up greatly. So I would say that right now the market view is up, then it is a long. Generally, it's a long build-up. It's called long build-up. Okay. But right now, what is the case we are getting right now? Our case, live example. Okay, price is up right now, but OA no change. Then I would say this is a range bound. Okay, this is a range bound because OA is not up. I would say that only the price is up. The OAS is not up by minimum 10%. If the OAS is minimum 10%, then everybody is interested to buy the contract. So that is the reason why market is going up. So simple thing. Okay. And second thing, the price is going down. Bank nifty is going down. This OA, you can assume that this is speculation. So the price is going up, the speculation is also going up. How we are saying that the speculation is going up? Very simple answer. Since everybody is betting, everybody is participating, that is the reason why open interest is getting added. What is open interest? When new buy and sell contract is signed, then it is said to be open interest. Okay. So whenever the open interest is getting increased, so it is obvious that the speculation is very strong. So this seems to be a long build up, but in our case right now, if you take the last day example, bank nifty is up, the OIC, the open interest is not up by 10%. So I would say that actually it is a range bound. So next case, the price is down, the price is down, and open interest is also going up, which means that everybody is shorting. So it's a short build up. So we can consider this one as a corona fall. So in the corona fall, everybody was shorting the market. When everybody is shorting the market, the OA, the open interest, is also getting added. So if you are into trend following, right? So these are the two cases you should look. So this one is a bullish view. This one is a bearish view. Okay. There are two more cases. I'll explain. Right now the market is going up, but OA is coming down. It means that open interest is getting close. So what is the meaning? The market is going up, but speculation is coming down. It means that the strong short market is coming down. It's called short covering. So short covering is also bullish. And the same thing, the market is going down, but OA is also going down. It's called either profit booking or you can say long unwinding. So this is also bearish. I would say this whenever the OAS is going up, this is a very strong trend. Okay, so even you do any directional play, you need to make sure that OAS is going up and the price is also reacting. So it does not matter what is the price is going. What is very important is if open interest is getting increased with the futures, which it means that the speculation is very strong. So in this scenario, so this bullish and this bullish is not so strong. This one is very strong bullish. This is also very strong. I would say this mild. So now you know actually how I am taking a market view based on future open interest. This option open interest, this is the future open interest, and option open interest we will talk later. And right now you should look only the future open interest. Guys, let me say this one, future open interest and option open interest somewhat interconnected. So the first thing you should look at the future open interest. So any condition which is not meeting these four cases, I would say that the market view is a range bound. It means that OAS is always less than 10%. Then it means that the market, I would say, according to the future, it is a range bound. In order to move the strike price up, or in order to move the price up, or in order to move the in order to move the price down, there should be always change in the open interest. When I say open interest, I mean is a future open interest. So right now, according to me, the price is up, but OI is not up by 10%. Currently, my market view is range bound. So this is the market view I have for today. So my market view, according to the future, it is a range bound, right? Very simple analysis, right? Guys, this is with the range bound. It is very important. I would say that this is having a weightage of 50%. If say for example this one is a heavy weight, it is in a bank nifty HDFC bank, right? The same way actually it is having a heavy weight. So okay, so with that actually I'm done with the future analysis. Let me shift to the max pain. Okay, I hope you can take notes. If you have any questions, you can ask in between. I'm ready to answer. Let me check out the questions right now. Any questions here? You can ask here. No questions yet. Okay, cool. Guys, let me go to the max pain part right now. Let me delete this part.
Jagan, before we move ahead, I could see there are a few questions which are coming in. If you can just kindly check the question.
Yeah. I'm not able to see the question.
So you just kindly expand the question panel the way I showed you up, and
Okay.
yes, and
Sure.
just the timing. So I it is 14:33 should be the latest timing. So you can just keep
Right.
scrolling. Yeah, thanks.
Yeah. I'm getting a lot of questions. Yeah. Okay. So you don't need to. Some people are asking the question. So good afternoon. Okay, thanks, and all these things is fine. So let me put on all these things here. Unable to hear. So let me come to the question part. So a lot of people are asking PCR. I will talk later. And some people are asking the question, Jagan, do I need to look at the price? You don't need to look at the price. What is so important is the open interest. So price is up by 0.1, 0.5% or 0.25%. You don't need to worry. You need to make sure that actually you are looking at the open interest. Open interest is very important, and the future open interest is very, very important. So what is 50% weightage? I will talk later. So it is a combined month. So is the aggregated open interest you should look. So when I say open interest right now, in say for example, let me put here. Okay, so current month, current and next month. So do not look the current month because you may be end of the month. So you need to compare the OA of the current month and next month. It's very important. And not low weightage. This one is a high weightage. Okay, bear with me for spelling mistake. So guys, so it's better to go with the straddle. No, straddle is having how much price? Okay, I'm done with that one. Okay, right. Guys, taking a future open interest is very important, because in order to analyze the price movement, right, bullish or bearish, the future wise is very important, right? So now let me delete all these things. So we have analyzed actually how I'm taking a market view, right? So now let me go to the max point. Guys, the max pain is different for different expiry. I'll explain what is expiry. So this is a weekly expiry and monthly expiry. Okay. It's going to be different for each one. So what is max pain? Okay, very simple concept. Max pain is nothing but in which strike price most number of contract will expire worthless right now. So let me repeat, in which strike price most number of contract will expire worthless. In other words, in which strike price, if this is the strike price at which the expiry is going to happen, then most number of option buyer will lose. Let me put it in a different term. If this is the strike price wherein the expiry is going to get, then most number of option seller will get a money profit. So the winner, so the max fine is designed in a such a way that option seller is the winner. Okay, but it is not talking about how much profit. It is talking about how many number of contract. There is a difference. So it is not the profit. If you are looking for a profit, then the term is called max gain. So this is the max pain. Okay, so each expiry we need to look. So this max pain, you can see it in multiple websites. I always go and see it in Sensible. So you can always log into Sensible. So you don't need to call, if you don't know what is max pain, it is not a big deal at all. How the max pain calculator, it is not necessary. Even the max pain value is not necessary. Let me explain. Okay, let me see the max pain first. So go to Sensible or any other website. It is available in Sensible, Option Opstra. It is available in Nifty Trader. It is available in Quantsub. So you can check this max pain at free of cost. Go to analyze data in option chain in Sensible. So this you don't need to calculate this max pain. So here we need to choose the Bank Nifty. Okay, and once you choose the Bank Nifty, there is a button, you can check it here. This is the info. So if you click info, it will show you what is the max pain. Right now the max pain is 37,700. So you don't need to check the market view on all this. You don't need to worry. So the max pain you need to check, it's 37,700. If you choose a monthly expiry, the max pain will be different. So for every expiry, the max pain is different. It means that for weekly expiry, if market is going to expire at 37,700, most number of buyer will lose. So that is the meaning of max pain. So for monthly expiry, if it is expires at 38, the most number of buyer will lose. So this is the max pain for a monthly. So for each expiry, the max pain is going to be different. So which max pain we should look, in which expiry we are taking a positions. Say for example, if you are taking a positions in monthly, you should refer to the monthly max pain. If you are referring to the max pain of weekly, then you should take a max pain of weekly. If you are taking a next month contract, then you should take a max pain of next month contract. So it depends on in which expiry we are going to trade. So for our current butterfly system, we are going to trade only in a weekly. So we are going to take about 37,700. Okay, so right now the max pain value is 37,700. Okay. Max pain value, right? You can say max pain. Okay, 37,700. Yeah, let me put it here. And what is the future? What is the Bank Nifty value? 37,600 is the value. Bank Nifty value is 37. Guys, you don't need to worry about the price of 37, the Bank Nifty. You should only think about the max pain. Okay, as I said before, the value of the max pain will not say the market is bearish or bullish. What is the main key point here is the change of max pain. So in order to know the change of max pain, what you should know, yesterday max pain. So yesterday max pain was 37,500. You should note down. Okay, so this is very important. I am not really sure, but it was 37,500. Okay, what is important is the change of max pain. So the max pain value is not needed. The change of max pain is needed. If the change is positive, if the change is positive, then the market is bullish. I would say change of max pain is positive. Market view, bullish. If the change of max pain is negative, market is bearish. Okay. No change in max pain. Yesterday max pain and today max pain is same. Then it is going to be a range. No change. Then it is a range bound. As far I know, yesterday there was no change in the max pain. So I would say that here also range bound. So guys, according to the max pain also, it is the view is a range bound. Okay. So this one will have a weightage of, I would say 30% weightage. Okay. So guys, let me repeat, the max pain value is not important. The change in the max pain is very important. So you should know the max pain of yesterday and max pain of today. Some people will ask the question, Jagan, is it necessary to see the max pain? Guys, max pain will not move much faster than the price. Price moves left and right, but max pain will not move left and right. So max pain moves slowly and steadily better than the price. So it is the Heikanagi candle you have, right? So you have a candlestick pattern in the price and Heikanagi candle you have, right? So Heikanagi candle is somewhat better and better version of the candlestick. The same way, if you look at the price, then you will get a confused. Rather than look at the price action of the max pain action. So the max pain is moving up. It means that every option seller is betting on bullish side. If the max pain is moving down, it means that every option sellers are betting on the bearish side. If the max pain is not moving, then it seems to be a range bound. So it's a very simple calculation you can do. So based on this, weightage is 30%. Okay, this weightage let me explain later. The second is PCR. This is called, you can say, put call ratio. So this one, let me delete. So before that, let me get a questions, so that if you have any questions, let me ask. Okay. So let me go down and ask a question. What if Max OS started like this? What? So you need to check the max pain of close. It's very important. So daily you need to keep track of the max pain. The max pain is a fantastic indicator, guys. And I used to do all my max pain, all my adjustment using the max pain. So many people are asking actually, how do I see the max pain in live? You can see the max pain in live with the sensible in option offshore. All these places you should be able to do these strategies. Can I do these strategies based on Nifty? Yes, it can be done with Nifty. It can be done with the Bank Nifty. Historical max pain, you cannot see it. Nowhere it is available. So very simple, guys. Okay. Check out the max pain of previous day. How to check out the max pain? You have to note down. There is no historical max pain available. So you have to note down the max pain of yesterday and today. So that actually historical price is available, but historical max pain is not available. This max pain is updated in live in all the websites. So you can go and check it. So guys, with that, max pain is over, right? Next. So this one is a put call ratio. So let me put the one, this one is clear. Important thing, important factor. Let me write down here. Important factor, OI should be above by 10%. And here the important factor is change in the maximum. Okay. Put call ratio. So it is nothing but whether the put open interest is more or call open interest is more. So everybody is betting on put. Say for example, you are seeing Y, put Y is high, market view, which means that most of the people sold a put. So then it is bullish. CPOIS is high, then P, then the market is bearish. This all we know. So the PCR is, say for example, CE and PEY is are same, then it is a range bound. So some people will say that PCR is nothing but CE open interest divided by PE open interest. Sorry, it's PE open interest divided by CE open interest. It means that, say for example, let me give an example. Okay, you have 200 open interest in PE, okay, and CE open interest is 100. It means that put open interest is more, call open interest is less. Then the PCR is going to be 2, because 200 divided by 100, it is going to be 2. So if the PCR is more than 1, people say bullish. More than 1, this market is bullish. And PCR is less than 1, people say market is bearish. And PCR is exactly 1, it means that actually the market is bearish. So what is the PCR is 1? It means that put open interest is more. That is the meaning. Okay. If the PCR is less than 1, actually it is a call open interest is more than put open interest. Then people say it is a range bound. But in reality, guys, most of the time for Indian market, most of the time, the PCR is always higher than 1.2, because many people are buying this put option for their hedging. Many people are selling the put option for cash secured put. There is a separate video wherein I had put it into YouTube. You can always check. People are much interested in put option in Indian market, in all over market. So naturally, the put open interest is always high in any kind of market. You go to US, you go to India, the PCR value is most of the time it's always higher than 1. How many people noticed it? I'm not really sure, but PCR value is always higher than 1.2 in Indian cases. So the PCR value is not so important, but what is so important, the change in a PCR is very important. Say for example, yesterday it is 1.2, right now it is 1.4, then it is a bullish. Yesterday it is 1.2, today is 1.2, 1.0, then it is a bearish. So guys, do not look at the PCR value. You need to always look at the change in PCR. Okay, so naturally, say for example, Indian market is a bullish market. So most of the time our put open interest is more. So we need to check out the relative theory, not the absolute value. So absolute value will not tell any value. Whether it could be a MACD, whether it could be a PCR, will not tell you what is the actual market at all. Sometimes if the PCR is coming from 2 to 1.5, then I would say it's a bearish. Some people say that Jagan 1.5 PCR value is bullish, right? The put open interest is more, right? So it should be bullish. No, actually no. Yesterday we had 2 times. Today we have only 1.5 times. So by relative theory, the market is bearish. So the guys, the PCR, I would say that actually you should always compare the yesterday one and today one. The minimum value I am looking for is a 0.2% change. I here important factor 0.2. So PCR value and today value the same way can sensible, you can go there and then analyze data, option chain, okay, and then info, you can click, you will be seeing the max pain, right? The same way you can see here 0.086. Okay, by looking at this one by textbook, this is bearish. Why? Because bearish, it is less than one. Less than one, people always say bearish, 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 but it is not really so. We should know what is the max PCR value of yesterday and today, how the open interest is getting changed from yesterday to today. Okay, so that's most important. So here also I would say that it's a range bound, because yesterday PCR value, if you go and refer, it is close to 0.9, and today PCR, you need to keep track of the PCR of yesterday and PCR of today, how you are tracking the price, right? So the same thing, yesterday and today on close. Okay, on close, okay, is 0.86. There is not much change, the change is only 0.4. Then I would say that view is a range bound. Views range bound. So that is the reason why this one is having only 20% weightage. So here 0.2. Guys, then you may ask the question, the put call ratio is very clear. Even you don't know how the PCR is calculated, no worries, but take a PCR of yesterday, take a PCR of today. If it is going up at least by 0.2, it is bullish. If it is going down at least by 0.2, it is bearish. It's not going down by 0.2, it is going up or down below 0.2 points, then it is a range bound. Example, yesterday the PCR value is 0.9 and today the PCR is value is 0.1, then the change is 0.1, right? So then I would say that market is a range bound. Very simple. People ask the question, Jagan, can I do change in open interest? I would say that not needed, because everything is discounted with the max pain and PCR. So why I'm saying not needed? The change in open interest will be reflected in PCR, will be reflected in max pain, and you don't need to worry. And high open interest is needed, Jagan, not needed. As I said before, all these things are included in max pain and PCR. It means that if the so much open interest change, automatically it will reflect in PCR and max pain. So you don't need to analyze these two parameters. Change in open interest is not needed, high wise is not needed. Everything will be discounted in max pain and PCR, because when I started my career, I had been analyzing this fourth item, this fifth item, and over a period of time, I started realizing that change in open interest and high wise is those two things are needed for market. Only these are the key parameters you need to check. So let me come to the question, then let me go with the weightage. Let me open a question. Okay. PCR value, you should look at what is the change in the PCR value. So you should not look at the percentage. I said it's a 0.2. So 0.2 not a percentage number. Okay, so it is not a percentage. So 0.2 is the because most of the time the PCR value is going to be from 0.5 to 2. Okay, so 2 is the worst one. So you can take at end of the day. So end of the day you can take a trade. So yesterday PCR and today PCR you can check. Maybe at 320 you can take. Okay, so that's it. Can we get the max pain and this one in Python? You can write the queries, you can write a program to get a PCR and max pain. It is absolutely possible. PCR is available in multiple places, even in India, and Infoline website, Sensible, lot of places you can go and check the PCR value, so you can check it. Yeah, money control, you can't check the PCR and max pain. Historical one, nowhere it is available. PCR and max pain, historical one, you have to keep a data, so no one will do that. right? So guys, with that, let me go to the weightage. So sometimes, right? So market view. Sometimes future will say long, and Max Payne will say future will say bullish, and this one will say bearish, and this one will say range bound. So overall view is bullish. Why? Because this future is like a HDFC Bank in Bank Nifty. Okay, and this Max Payne is like a ICICI Bank next weightage. This PCR I would say is like a Axis Bank or Kotak Bank. Okay. So this one is having a heavy weightage. When future says bullish, then you don't need to look these two things, because future is the master. Future is the master. There are many cases. Price will run up. But there will not be any change in the max pain. There will not be any change in the PCR. So in such a cases, you should take a bullish view. In Corona fall, right, so the price was coming down, but the max pain was not moving. Okay, but the PCR is not moving. In such a cases, you should take a bearish view. It's very important, right? So in such a case, you should take a bearish view. Okay, so that's it, guys. That is the reason why it is not a equal weightage, it is a heavy weightage. Okay, so this one is having a 50% weightage, 30% weightage, 20% weightage. But for the time being, right, so for our view, so unfortunately we don't have any directional view for tomorrow. Based on the yesterday's setup, the market looks range bound for a given day. Okay, so let me give one more example. Say for example, this one is bullish, example bearish, bullish, then I always go with bearish. Okay, first one I will listen to the future, how the HTIPS is dominating Bank Nifty. The same thing, the future OIA will dominate the market view. It is very important. Okay, so these three things are interconnected. 90% of the time, if it is bullish, this max pain also will be bullish. If it is a bearish, most of the time it will be bearish. If there is a big trend in the market, sometimes this will behave in opposite direction. Okay, so sometimes, very rarely, but in such a cases, you should go with always with the future Y. It is very important. So market view is a bearish or bullish. So this is how you should take it. Let me go to the questions and come back. Oh, I don't think so. Where we get to check the YI, you can check in the YI in Money Control website, or you can check your website. So let me put here Max Pain. Where will you get? You'll get with the Sensible. You'll get with the option Armstrong. You'll get with the Nifty Trader. You'll get with the Quantsub. Okay. Historical one, no. You have to keep track of historical one. Okay. YI, you can check with NSE, you can check with Money Control. This one. PCR also you can check here. So clear, right? So that's it, guys. We are done with the market view. So market view is very clear, right? So let's go to this one. You can note down the weightage here. You can, very simple. So future, max pain, what is the weightage we have? So we have done a live right now. So for a current market view, for tomorrow, my view is a range bound view, right? Guys, the next one is what is the strategies we are going to do? So we have three strategies. So for bullish view, we are going to sell a put butterfly. For bearish view, we are going to sell a call butterfly, and we are going to create a call butterfly. And for range bound view, we are going to get a double butterfly. For a today market view, we are going to do a double butterfly, because According to our analysis, market is range bound today. So we can check it here. So this is market view. How we got this range bound view? We analyze the future, we analyze the max pain, we analyze the PCR. All these parameters are saying that market is range bound. So that is the reason why we are taking a range bound view for Monday morning. Okay, so that's it for market view. Right. Coming back to this one. Okay. So market is bullish. Generally, most retail will do sell PE, if I'm not wrong, right? So and big boy put butterfly or put credit spread. Okay, and bearish, most retail people will sell a call, naked call, right? This is naked. So now we are going to do, if it is bearish, then we are going to do call butterfly or call credit spread. Okay, and range bound, most retail people will do short strangle, naked. And we are going to do double butterfly or we are going to iron condor. Okay, what is put credit spread? Say for example, sell higher strike, buy lower strike. That is a which we are not going to do. It is not giving super return. So which means that, say for example, sell 37,500 put and buy 37,500 put, lowest strike price. So what is the call strike price? Sell lower strike price and buy higher strike price. It means that, say for example, you sell 38 call and buy 38,500 call. Even somebody is trying, this is what the risk defense strategy most people will do, but we are not going to do this strategies for our sessions. We are going to concentrate on this. We are not doing because the risk and reward ratio is not so good. Okay, and we are going to do only this. Okay, so instead of selling put, it's called put butterfly. Instead of selling a call, it is a call butterfly. Difference is this one is a risk undefined and this is risk defined. Here the loss is unlimited. Here the loss is limited. That's it, guys. So any questions? Let me come to the questions, then we'll do this one. Guys, you will have a lot of questions. Don't worry about that. You can always ask the questions later also. So no need to worry about all these things. No need to do adjustment. Adjustments will come. Butterfly strategy, let me design. Okay, so how to deploy all these things I will explain later. So your idea is a debit spread or credit spread. So it is not a debit or credit. Okay, so guys, I don't think so we have any big questions right now. It is going to be the right. Let me go back to the slides again. Okay. 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 Guys, before that, let me explain one thing. Okay. So delete. Okay. What is risk defined strategy? What is risk defined strategy? Number one. Okay. Okay. Loss is limited. Loss is limited. That is a risk defined strategy. It could be any strategy. Loss is limited. Second character is loss is limited. Second character is combination of option buy and sell. So that's what actual risk defined strategies in option selling side. If you buy only options, it is going to be risk defined, but we are option seller, right? So buy option seller, so we need to have a buy for every sell. At least for every sell, if your sell is 10, then the buy should be 10. Okay. Some people will do for 10, let me buy 9. Okay. This is not a risk defense strategy. This is not a risk defense strategy, guys. This is, I would say that this is risk undefend. Okay. This is risk defend. Okay. If you are doing 5 sell 6 buy, then it is I would say this one is risk defined, and this is also risk defined. So the which one is good? So risk defined is the one is good. Okay. For every cell you need to keep a buy. So the 10 or 5 I'm going to replace is n. N could be 10 or anything. So for n cell we need to keep a n buy. So in butterfly what we are going to do, for we will have a n cell and n plus 1 buy. It means that what does it mean? If we have 5 cells we will have 6 buy. Okay. If you have 10 cells then we will have 11 buy. If you have 10 cells we will have a 21. So what I mean is actually for every cell we keep a extra buy. We keep a extra buy. I'll tell you why. Okay, so we keep a extra buy. So that is the key point in option in butterfly strategies. So it is not, most people will do n is to n. Okay. This is, I would say that this is orthodox people. For n cell we keep a buy. Orthodox. Orthodox is most retail people will do. So this is a unorthodox or elegant way, or you can say, what do I say that? Better way of doing the butterfly. Okay, so this one you are going to do with better way, because the net buy is always long. You have a net buy always long. Net position is net buy. How I'm going to do, I will explain. So first you should know what is risk defense. For every cell you need to keep a buy. If you're selling 10, you should keep up 10. So that is a risk defense strategy. But in our case, we are going to have an extra. If you are selling 5, we are going to keep a buy extra 1. So how we are going to do, how we are going to choose the strike price, how we are going to choose the premium, I will explain later. So right now, so this is what, right. So now we know that actually we are going to sell, we are going to buy. We know the ratio. So the ratio is very simple. If you are selling 5 options, you are going to buy 6 options. So which option we are going to sell, which option we are going to buy, let me discuss. So before that, let me come to the questions. If you have any questions, let me ask. So in a way, you can say that I'm an option buyer because I'm keeping more option buy. Okay. Okay. When we look at, can you please do the example with the Nifty? Let me do the example with the Bank Nifty, guys. So then I'll ask. So right. So let me put the color in light. So some people are asking for it. So so that you can take a note. So this is light, this one. Okay. So light color, let me put. Risk defined, this risk undefined. So some people are doing, I know that actually, Jagan, can I do 20, come on, 19 or 18? No, risk undefined. You should do very simple. If you're doing 20, you should do that 21. But ours is most of the time it is going to be 20. If it is most of the time it is going to be 21. Okay, so actually it is not. So whenever we do 5, we do 6. So it means that 20 means into, then it's going to be into 4 into 4. Then in most of the cases 20 into 24. That's how it is to have. So most of the time our ratio is 5, 6 most of the time, or else our ratio will be 4, 5. So that's how we used to create. So let me keep it 5 into 6. So that's how we are going to keep. Right. Let me come to the norms. Okay. So selling norms and buying norms. Right. Okay. So let me delete this and then come back to the strategies part. Okay. So okay, coming back to, okay, guys. So before that, okay, so you should know the first thing. Let me know. You should know selling options, buying options. Okay. Sell options where DK is faster and the premium is high. Premium is high, both. Okay. So sometimes in the money options are high, so you should not do. In ITM options, the premium is high, but DK is not faster. So this is wrong. This is wrong. Okay. You should not do ITM. Okay. ATM, DK is faster. Yes, you can sell, but I will come to that. Okay. Then one OTM, one standard deviation. You lost one standard deviation. I'll talk later. This is super duper option. This is super duper option. This is, I would say, mildly positive, but the risk is more. Okay, so let me put this one. Okay, so guys, this one, let me put this one. So selling OTM option 1SD, I'll tell later actually what is 1SD. But if you're selling OTM option, the DK is faster. The 1SD premium is always good. Okay, so it is not really bad. So in other words, okay, sir, right? So this is good. Okay, and for OTM, so for example, 3SD. In 3SD, no premium at all. The premium is ultra low. The premium is ultra low. So hence, this is not good. I would say this is not good to sell options. Let me put this one. And this is, there is no decay, I would say. Why we are not doing this ITM option? You are not supposed to sell because there is no decay at all. Okay. And ATM options you can do, but RR is bit risky. Bit risky because anytime it may go in the money option. Better. Here, I would say that for OTM, no premium. The DK is good, but there is no premium. The premium is going to be 5 rupees, 10 rupees. So there is no use at all. So this one is better to sell option. Okay. Buying option. So you need to buy where the DK is slower. Either the premium is low or premium is low. This we can put R. Okay. Either the DK is slower or the premium is low. Okay, so very simple. ITM option, yes, you can go because no decay. It's good for option buy. It's good for option buy. So this one is always good for option buy because there is no decay. Always better, right? And ATM option, again I would say no, because the decay is faster. The decay is faster. And OTM option, again I would say that no. Decay is faster. This one, I would that you can buy 3SD or 2.5SD, wherein the decay is faster, but ultra low premium. Let me give an example, then we will come to know. Okay. Okay. Say for example, you are touching this 500 rupees is the in-the-money options in Bank Nifty. Okay. This in-the-money option, the decay is less. So buy this option. Okay. Then you may ask a question, Jagan, 500 rupees, if you're losing, we are going to lose 500 rupees, right? So for which we'll give a, we will go with another, we will manage with the credit. Okay, so don't worry about this. So we are going to buy this option. Okay, number one, ATM option, never deal with ATM. Simple gamma, because RR is very high. I mean, reward is also high, risk is also high. Okay, so we are just eliminating this option, ATM options. Okay, and that is the reason why we are not doing. Okay, next is 1SD. Okay, 1SD is always, say for example, this one is the premium. I would say never deal with this one because the premium is 200 rupees. Okay, and this one is a gamma effect. You can say that never deal with ATM because ATM is the decay is faster, you will get a profit in long run, but the risk and reward DD is everything is very high. Okay, so don't deal with. Okay, and the pop is also very low. Okay, and OTM options, if you are selling 1SD, I'll explain what is 1SD. Say for example, this is 125 rupees OTM option. So in the money option, it is 500 rupees. At the money option, it is 200 rupees. And OTM option, it is 125 rupees. So that's what we are going to do. And this one, we are going to deal because the decay is faster. So always sell option. Sell options. Okay. And ultra low premium, say for example, it is 15 rupees. We are going far OTM. The decay is faster, but the premium is ultra low. Ultra low. So we are going to take this trade. We are not going to hold this trade till the expiry. Even you lose some money, this 15 rupees will go to only 10 rupees or 5 rupees. So thus it's going to be more beneficial if you buy options. So guys, so we have 4 options: 1, 2, 3, and 4. Right? One is in the money option, another one is ATM option, third is 1 standard deviation, which means that right now you can assume that 1 standard deviation is little OTM. You can assume the little OTM. Let me explain what is 1SD, little OTM, that is 1 standard deviation, and 3 standard deviation is far OTM, wherein you are going to buy. So first option, it is good to buy. Second option, it is no, don't deal. And third option, we are going to sell. And fourth options, we are going to buy. So the ratio, most of the time, it is going to be buy one option, sell 5 options and buy 5 options. So that is how we are going to do. So when you buy this one, say for example, for 500 rupees, how much it comes? Plus 500, sorry, minus 500, because when you buy, you're giving the debit, right? 125 rupees into 5, how much it comes? You're getting a credit of 625, if I'm not wrong. Correct, right? 625. 125 into 5, sorry, 625. How much it comes? Wait, let me calculate. 125 into 5, it comes to 625. And 15 into 5, how much it comes? 15 into 5, 75. So this one is going to be debit. Why it is debit? This one we are buying and this one we are selling. So close to, if you are buying this one for 25, okay? So this one buy, this is this total premium bought, this is total premium sell, and this is total premium buy. So putting it together, your total value is going to be 0. So this is how we are going to create a butterfly strategy. So we are going to buy in the money options. How long we are going to buy the in the money option? My take will be 0.5 SD. I'll explain what is SD. 0.5 SD is the in the money. Little in the money, very little in the money you buy, okay, and then slightly out of the money you go and sell, and for OTM you buy. So this one we are going to buy in 2.5 SD. So the idea is we are going to keep 2 buy 1 sell. We are going to keep a 2 buy 1 sell. Orthodox butterfly will look like 1:2:1. So that is the orthodox butterfly. This is orthodox butterfly. But I teach again butterfly. It's going to be 1:5:5. So we are keeping one net buy because the total bought option is 6 and total sold option is 5. So as I said before, we are going to one more extra buy. So this one we are either going to create in sell side, put side, or else we are going to keep it in a call side. Sometimes we keep it in both the sides. So that's it, guys. Let me come to the question, then I will explain what is standard deviation. So the idea is, guys, very simple thesis. Buy option where the decay is less, okay, or that though the decay is faster, you buy only for cheaper one. Either you go in the money or you go for OTM. Either you go in the money or you go for OTM to buy options, so that you will not suffer from decay. Okay, sell option, but don't sell option at the money, because at the money options will decay faster. At the same time, the risk is more. So we are eliminating this second point, second case. Okay, we are selling only for OTM because there is a decay and you are little bit away from the at the money, so you are safe. So that's what we're going to do it, and we are going to make this butterfly system completely risk defense strategies. So once I'm done with this one, let me put everything in a payoff. I will show you how the payoff will look, how you are going to make a profit. So now the purpose of this slide is to let you know that you need to, which strike price you need to buy, which strike price you need to sell. So whether to buy the in-the-money option, whether to sell in-the-money option. So if you have any questions, you can ask. Okay, is it a kind of martingale? No, 3 strike prices involved. Yes. Once we build a view, market view, after that EOD next day view can get the naked at that, right? So can I sell 1 lot, then we'll buy 2 lots? No, you are not supposed to do. You need to, if you do 1:2:1, then it's very difficult to make profit. So orthodox butterfly, it is very difficult to make money, but I teach again butterfly, most of the time you are going to make profit. So that's how I had been doing this one. Okay, guys, so let me go to the standard deviation. So which strike price and all these things, it depends on the standard deviation. So additional buy, yeah, that you need to talk with this one, your broker. Okay, so right, guys, next one is SD. Okay, so what is SD? So your call premium example, okay, your put premium example. Guys, if you want to know the SD, then you need to finish the MSc mathematics and then PhD, then only you will come to know what is standard deviation. Okay, so there is a lot of jargons available with the standard deviation, but you don't need to worry about all these things. I'll tell you simple calculation to know the SD. You don't need any Greek software talk. Say for example, at the money call premium is 200, okay, and at the money put premium is 200. You need to sum both, then it is said to be one standard deviation. Simple, 400 rupees. And at the money call premium is 500, and at the money call premium is 500, then it is 1000 rupees. Sometimes it may be 400, this may be 300, it may not be equal, then it is going to be 700. So one standard deviation refers to the premium, call option premium plus put option premium put together, it is called one standard deviation. When the VIX is high, the call premium is high, the put premium is high, so the standard deviation will be bigger. When the put premium is less, when the volatility is less, when the VIX is less, the call premium is less and the put premium is less, thus the standard deviation is also less. So this standard deviation will tell you what strike to choose, because we cannot choose. Say for example, Jagan, can I sell 200 points away? No, because 200 points away, it is not safe right now. But in 2014, 200 points away is safe. So how do you define 200 points is safe, or 500 points is safe, or 1000 points is safe? In Corona fall, even 1000 points is not safe in 2019. So at what point we need to take a strike price? It all depends on standard deviation. Standard deviation depends on call premium and put premium. So always go with one standard deviation. So now you know what is one standard deviation. Okay, so now let's check the one standard deviation of Bank Nifty. Okay, so guys, let me check the live one. Okay, you are able to see it right now, right? So where is the market right now? It is 37,600. So we need to look at the 37,600 call and put. Correct na? So 37,600 call. So 495 and 12. 495 and 512. Let me put as a 500 right now. So right now the call premium is 500 and put premium is 500, and totally what is the premium we have in total? 1000. So right now for a given day, Friday, the standard deviation is 1000. The standard deviation is 1000. Very simple. 1000. Okay. Clear, right? So now you know what options you need to buy, what options you need to sell. So I had said, so what is the market right now? 37,600. Market right now it is 37,600. According to the logic, whatever I said, which option we need to buy right now, guys? So 0.5 SD comes to 1 SD is 1000. Then 0.5 SD comes to how much? How many points? 500 points in the money. 500 points in the money. We are not going to deal with this guy. Which guy? This guy we are not going to deal. So let me remove this guy. Okay, so, and we are going to deal only with 1 SD. What is 1 SD? 1 SD. Then we are going to sell options at 1000 points. How do you know this 1000 points? Because at the money call and at the premium put together, actually we are going to get this one. Okay. And what is 2.5 SD? Okay, 2.5 SD comes to 2500. Okay. So now you know we need to buy in the money option 500 rupees. We need to sell out of the money pass 1000 rupees. We need to buy this one actually 2500 rupees. Okay. So this is the strike price we are going to choose. Any question, guys, about a standard deviation, which strike price we are going to choose? The next part is what is the ratio we are going to do? 1:5:5, or 1:4:4, or 1:6:6. So we are going to do. So let me come to the question part. Let me open a question part. Can we get an Excel sheet? Yes, you will get an Excel sheet because it is, the recording is available. You can always look at this one. Okay, so the buy, you can keep it as 2.5 SD or 3 SD. It does not matter. So it depends on this one, right? So let me, I think how to deploy the strategy. Okay, so fine. I'll come to the part right now. Now I said actually what is the strike price we need to go, right? Right. Guys, done, right? So let me put this strategy in put side. Then you will come to know, right? What is the strike price we are going to do. Oh, cool. So let me delete this. Where is bank now? Bank Nifty is 37,600. Okay. So now the strike price at which we are going to do strike price. Okay. Which one? 37,600. We need to buy the in-the-money option. Buy means this one we need to. We are going to do a put butterfly right now. Okay. For put butterfly. Oh, sorry. Put. Oh my God. Put butterfly. Okay. Put butterfly. How? This one. B1. $38 100 you need to buy. Right. Let me open MS Paint. Okay, guys. So 37,600 is the market, right? And 1 SD is 1000. Okay. This is OTM put. This is in-the-money option. Okay. 0.5 SD means that half SD. Okay. Half SD. It comes to 500 points. Correct or not? Right. So this one plus 500 rupees. You need to go in the money option. So it's equal to 38 100. This put. This is said to be ITM option. So 38 100 put we are going to buy. We are going to buy this one. Buy ITM. What is the value right now? 38 100 put. Let me check it. 38 100. The 746 is the price. 746 is the price of. Let me put this one. 746 is the price you are going to buy. This is the put option you are going to buy. So it is going to be a debit strategy. It's going to be a debit strategy, right? Next, 1 SD. So 1 SD, let me come to the paint. This one SD is how much? 1000. So plus 1000, sorry, minus 1000. It's going to be where 36,600 put. Correct na? Yes or no? This is OTM option. This is OTM. How long it is OTM? 1 SD. What is 1 SD? 1000 rupees. How you got this 1000 rupees? At the money call option and at the money put option. So 36,600 put options we are going to sell. This is sell OTM. The right word is sell 1 SD OTM. Okay, this is sell half SD ITM. Okay, right, perfect. So this one, what is the premium? Let's check it in sensible or NSE option chain. 36,600, right? What is the strike price we have? 36,600. 36,600 is 206. 206. Okay. So let me write this. Right now it is 206. 206. Right. And what is the last step? What is the last step? We are going to buy the for OTM. Which one we are going to buy? From here. So this one we bought. This one we sold. Say for example, this is the strike price you have, and 2.8 5SD is going to be 2500. It is far OTM. From here, 2500 points less. So it comes to where? Help me with the strike price. Which one? From 37,600 to 2,500 less, it comes to 35,100 if I'm not wrong. 35,100. Here we need to buy. Which one this is? 2.5 ST. So buy of ST, okay, and sell 1 ST and buy 2.5 ST. So this is what we are going to have. Okay. Now what is the premium we have? So this is 35,100 PE. Okay, this one is buy 2.5 SD. And kitna premium? How much premium we have? 3.1 is 55 rupees. 55 rupees. Okay, and this one is buy. This one is buy. Okay, so let me keep this one is 5. This is one lot I'm going to do. This is I don't know. Let me put 5. Okay, and this one let me put the same thing. Okay, if it is a 5, it is going to be buy. This is buy. This is sell. This is buy. Guys, note down. This is buy. This is sell. This is buy. So the net credit, right? Net premium. Okay, I'm going to do that. Okay, so this I'm doing it for, I would say that net premium. Okay. Oh, okay. So now let me put this one, this one, and this 746. If you're doing 5 lots, this one with this, it's going to be 1030, and this one, if you're doing 5 lots, going to this one, and the total is going to be some of 9 rupees. Okay. So if we put everything together, it is coming close to 9 rupees credit. So you should do this strategy with no debit or no credit. Almost no debit, no credit. 9 rupees is almost no credit, no debit. Say for example, if you put 6 here, then you are getting 160 is the credit you are getting. If you are putting 3 here, then you are getting debit of 293. If you are putting 4:4, then you are getting 142 rupee debit. If you are putting 5:5, then you are getting almost no credit, no debit. Guys, this is how you should fix the ratio. Very simple calculation you are going to do. You are going to choose 1 SD, half SD, 2.5 SD. Then you are going to choose the ratio. This you are going to do in only in a put side. The same way you are going to do it in a call side. If the market is bearish, this is how you should take a put butterfly. If the market is bullish, you should do the same exercise in call. So how you should design a butterfly. So it is not a simple thing. Come here, sell some strike price, some premium, and buy here, then you will have a good return. So it is not really so. So let's put before that. Do you have any question in the strike price? Let me put all these things in payoff diagram so that you will get a better clarity. And so far it has been great, and I will be able to see how you should design your strategy. So this is for bullish view. If it is a bearish view, then you should design a call butterfly. That also I can help you out shortly. But right now, if you have any questions, you can ask with standard deviation or choosing the strike price and how I'm able to get this net debit to 0. I think it is more techie item. So, but you should do this calculation to make money. Yeah. So how much margin is we should get ended in E column and all these things? Okay, so that I will ensure. Okay, 2.5 ST, 35,100. No, 34,100. 37,600. Yeah, right. Right. So which premium should we always go for premium to gain more? No. Okay, let me put. So this question seems to be this one. So guys, Let me close this one, E column, fine. Done, right? So let me put everything in a payoff so that you will come to know how it looks. So guys, let me go to the payoff of this put butterfly. So let me go to the strategy builder. Okay, build new strategy. So here I chose Bank Nifty. Okay, and which strike price we are going to buy? Put we are going to buy. So let me go to here where 38 100 is the one we decided to buy. Okay, so buy, clear, right? And then which strike price we are going to sell? Let me come back here. It is 36 600 we are going to sell. 36 600 we are going to sell. Here I am going to choose 5 lots. Okay, and then which one we are going to buy? 35 100 we are going to buy. So come here and choose 5 lots. Guys, this is how the payoff will look. Okay, so you are able to see this one. Good. So the payoff will look like this one. Wait for a minute. Okay, so zoom out. Zoom out. Okay, no problem. Let me put this one is here and this here, right? So guys, if you look at the margin right now, right? So it is 1.7 lakhs. Oh, if you do 1:5:1, most likely the margin is 2 lakhs. Most likely the margin is 2 lakhs. Okay. So let me reset here. Let me reset here. So right now it is here, right? So it is for bullish view. Okay. And you can check the payoff, right? This is the payoff for expiry. This is the payoff for expiry. Guys, this is this blue color you are seeing, right? So this blue line you are able to see, right? So this blue line is called T plus 0 line. T plus 0 line. What is T plus 0 line? Now you can move in which day you will get how much profit. So Monday, if you're keeping these positions open, okay, nothing happens by 3:30, okay, the market is going to be in the same place, then the projected profit is 6,400 rupees. 6,400 rupees. Why? Because simple thing, here you bought option, here you sold option. It is very important. If there is a black span event, you are not going to close to 56,000 is the, if there is a worst cases, then you may lose 55,000 is the number, but this is not a realistic number because expiry day you are going to lose 1.1, whereas with the Monday, right, you are going to lose 58,000 56,000. Okay, but keep in mind that this is only if you are keeping till the expiry. If you are going to close this trade by tomorrow morning, you are not going to lose much. So it's very important. You may lose, say for example, 10,000 rupees or 5,000 rupees. If there is a black span event, then you're going to make profit because the net buy is long. If there's a big crack in the market like the corona, then you are going to make a loss. The only scenario the loss will aggravate is if the bank nifty is coming to, if the bank nifty is coming to this strike price, the strike price at which you sold, then the loss is coming to 15,000. But by the time, you will not sit idle. By the time, we will be closing our positions. If the bank nifty is coming to the sold price, which is 1,000 points away from the spot, which is 1,000 points away from the spot. So most of the time, guys, you are going to make 1,000 rupees, 2,000 rupees every day with the 2 lakhs margin. With the 2 lakhs margin, every day you are going to get 1 lakh or 2 lakhs rupees loss in worst cases, right? So if the market is coming to the strike price at which you sold next day morning, okay, market opens flat, then it market is coming down, no issue at all, because we are going to close this trade by 9:20. Okay, so the worst case, the most of the time the loss is going to be 15,000. 15,000 is the worst case loss. Okay, right. So this max loss and this loss is applicable if you're keeping the trade till the expiry or till 3:30. If you're closing the trade next day morning, most of the time your loss is going to be 15,000, right, guys? Now let me do this calculation for call butterfly. So 37,600 minus 500, it is going to be 37,100. Correct na? 37,100. And then it's going to be 38,600. 1,000 points away. Correct na? And 2,500 point away. Which strike price will come? It's going to be 39,600. Call. This one is 38,100. This is 37,100 called. Call. What is the strike price we have? 37,100. Where is it? Let me choose Bank Nifty. 37,100 is 838. How much? 838. Okay. So we're going to buy 838. This is net buy, so it is going to be debit, right? And 38,600. 38,600 call. 120. Okay. And then which strike price we are going to do? 39,600. 39,600 is 21 rupees. Okay, 21 rupees. Let me put 1:5:5 ratio. Okay. Let me check actually how it comes. So this one to this and this. This one is going to this by this. This one is coming here. The 21 into 5 is coming to this. This one is a buy, right? Total sum of these three things. 343. Then you need to make this one as a 6, 7. Then you have to make it as a 8, which I don't recommend. In such a cases, what you can do, either this is the call option, you can always come little bit closer. Okay, I would advise if it is a call options, you do, because the call option premium is always cheaper. The call option premium is always cheaper, right? And that is the reason why sometimes it is better to not to go more than 1:6:6. You should go 1:, high maximum is 1:6:6. Don't go for 1:8:8. It is not recommended. In such a cases, what I can do, the sell options you are doing 1:, this you can keep it with 0.8 SD or 0.9 SD. Let me choose 38,500 because this problem have only with 38,400. Let me choose 171. 38,400. 38,400, 171. Okay. Okay. Then what you can do, 6, 5, 6. Okay, let me choose 5. Getting 8 rupees debit. So fine, right? So 88 rupees debit. If I put 6:6, then I'm getting 83 rupees. So let me go with the debit. Okay, so 88 rupees debit is fine, right? So let me choose this one also. 37,100 call buy, 38,400 sell, 39,600 buy. Okay, let me go to the option strategies. So reset my price. Let me go here. What is the strike price I'm going to buy? Is 37,100. 37,100 buy call. Okay, so this one buy. Okay, and 37, 38, 400 sell. How many? 5. Okay, and then which one you are going to buy? No, and it is not. It is 40,100 if I'm not wrong. 40,100, 2,500. Okay, so 40,100. What is the premium right now? 12 rupees. Minus 12. So minus 12 is the price. In call side, right? So most of the time I need a black span even only in a put side. Most of the time in call side I used to do 1:5:4. But if you want to do 1:5:5, it is fine. If you do 1:4, 1:5:4, then it comes only 43 rupees daily. So let me put this one. Okay. Okay. Putting it everything. This one is 5:5. Making it 43, then it is. Let me put it 5. Okay. So in call side the debit is credit is 9. In put side the credit is 9. In call side the debit is 43 rupees. So that's what I'm going to do. So let me do this one and 5 lots. Done. Let me reset here. Let me reset here. Guys, look at the payoff. It looks great, right? So the break even you're going to get, you can check it here. Break even is 36 to 33 and 38,700. Okay, where is market right now? Market is, we saw 37,600. Okay, break even is first break even. Okay, break even is downside. Where is it? It is 36 to 33. 36 to 33. In call side, where is the break even? 38,700. Sorry. So in downside, the break even is almost 1,400 points down. In upside is the break even is 30. It is almost 1,100 points. Guys, this if the market is coming 1,000 points away, if market is not moving more than 1,000 points away, by next day morning, most of the time you're going to make a profit. Very rarely you will get a loss. So this is the power of butterfly strategy. If you do 1:2:1, you don't make much profit, but you should do 1:5:5, and at the maximum you should stick with 1:6. 6:6. Okay, coming to the margin, you look at the margin. At the maximum the margin is needed is 3 lakhs. Okay, and if you are putting call and put butterfly, most of the time you are going to make more than 3,000 rupees. If you are putting butterfly in only one side, you are going to make 1.5 rupees, 1,500 rupees per day. Okay, so this you can do with Friday, Monday, Tuesday and Wednesday. 4 days you can do in a week. Don't do this strategy on Thursday. So let me come to the question part, then I will go with the position sizing. Okay, net premium is I mean, sometimes it is not close to zero. It should be, closer to the zero. That's what I'm saying. Okay, so the bullish view or bearish view. Okay, as I said before, you need to do a entry and exit. Bullish view, put butterfly. Bearish view, call butterfly. Range bound view, actually, most of the time we are going to do it in both the sides. Okay, so guys. Thursday, right? Yes, I'll come to the deploying the strategy later. Okay, so first we are designing the strategy, we are choosing the strike price, and we are making sure that our butterfly is not making big loss, right? So we are done with this one, guys, designing a butterfly. So let me come to the slides right now. So this is the butterfly I was talking in Excel, okay, unorthodox butterfly. The ratio is 1 is to n is to n, which means that 1 is to 5 is to 5. N varies from any number. Could be 1 is to 10 is to 10, 1 is to 6 is to 6. But my cap is 1 is to 6 is to 6. So don't go for more than 1 is to 6, 6 to 6. Okay. So the net buy strategy, which means that for every sell we have extra buy. This will take care of black span event. Okay. So this one you should enter 3:20 p.m. next day morning 9:20 you should exit, so that you can do the intraday after 9:20. If you are doing any 9:20 straddle, then the margin is fine. This is the abuse of margin. So you are doing intraday, then overnight you are taking this trade and then you are making profit. So this one I can do it. If you are doing any range bound strategy, right? So iron condor or monthly strategy, this will act as a uncorrelated strategy. What is uncorrelated strategy? When your range bound strategy is making profit, this butterfly will make a profit, because this butterfly is a directional strategy. Again, you are taking double butterfly, how it has become a directional. Guys, range bound is also directional. So if you don't know what the market direction, then it is a non-directional. So range bound is also one direction. Okay. So coming to weekly butterfly, this I have explained in Excel sheet clearly. Buy where the DK is less or the premium is low. Buy where the DK is less or the premium is low. Sell where the DK is higher. This is the secret sauce in option selling. So you need to buy where the DK is less, the premium is lower, and sell the DK is higher. And create a butterfly in ratio with no credit or no debit. It is impossible to have a zero credit or debit. It may be 30 rupees or 40 rupees. That you don't need to worry. You need to always buy half SD in the mini options. There is no DK at all. You need to sell 1 SD where the DK is faster, and sometimes with the call option 1 SD you will not get the ratio. In such a cases you can go for 0.8 SD or 0.9 SD. 0.8 to 1 SD you can do. And buy OTM options 2.5 SD where the DK is faster but the premium is ultra low, so you will not get a DK. So two options we are buying where the DK is less or else the premium is too low, and one options we are selling where the premium is high and the DK is faster. Weekly butterfly example, as I said before, this is the ratio we are going to get. For example, 500 rupees, you are going to put a ratio in Excel. So which ratio? Sometimes 1 is to 5 is to 5 will match, sometimes 1 is to 4 is to 4 will match, sometimes 1 is to 3 will match, sometimes 1 is to 6 will match, sometimes 1 is to 8 and 8 only will match. In such a cases, don't do. The max range is 1 is to 6 is to 6. I would say 1 is to 6 is to 6 itself is a peak one. 1 is to 5 is to 5 is the right choice. So this is an example of put butterfly. Buy 500 rupees, sell 125 into 5, and buy 25 rupees into 5. Example, it may not be the same example. I given a live example where you can check the debit or credit. The debit or credit should be close to zero. It is not exactly zero. It may be 10 rupees, 20 rupees, or minus 30 or 20 rupees. So live example I had shown you. So okay, risk management. Okay, so let me confirm. And this one you should never ever sell any naked option. So in butterfly strategy, never ever sell any naked options. It's not allowed. And don't trade for mega event. If there is a election result or budget or there is something tomorrow, then don't trade this strategy. So that's point number one. And always try to concentrate on this one. I'll explain later. Okay, so try to concentrate on 3% on the margin. So 3% on the capital, not the margin, on the capital. Okay. So I will come to that position sizing part, guys. So with this, actually, we are done with the designing strategies. Okay. So entry, I have set. Exit also I have talked. Let me delete this one. Okay. So entry 3:25 p.m. today. Exit 9:20 a.m. tomorrow. Is called sell today evening and buy tomorrow morning. Edge is capture. Edge is capture direction, capture decay, and margin is free for intraday. These are the three edges with this butterfly. Market is as per the view, you are going to make profit. Market is range bound, you are going to make profit. Say for example, you are having a bullish view and you are creating a put butterfly. Next day morning market is bearish. Okay. Next day market is bearish. Okay. The loss will be close to, okay, unless otherwise, till market reaches your strike, sold strike, where we sold close to 1SD, which is very most likely to happen overnight. Okay, if it moves 3SD 4SD now, then it is, say for example, market moves 1SD, then you may get a loss of 10k. Okay. Sorry, loss of 10,000. Okay. Example, I'm seeing the worst case. If market is cracking 3SD, black span, like Corona, profit, because we have a net buy. Okay, right. And next day market is bullish, profit close to 3,000. I mean, on average, you're going to make 1,500 rupees profit. That is a backtesting research. Okay. If market is range bound, bullish or range bound, you will get a 3,000 rupees profit if your view is right. Market is range bound, then you are going to make a profit of 1,000 rupees. Okay. Market is slightly bearish, no profit, no loss. Slightly bearish, but your view is bullish. Okay, slightly bearish. Okay, so even though you're wrong, you are not going to make a loss. The market should move at least 1SD, then only you will make a huge loss. Otherwise, you will not make a huge loss. This is not possible unless otherwise there is a mini black span event. Mini black span event, like we had what do you call, demonetization, right? So like this is a mini black span event. Okay, so in such cases you will make a loss. Okay, so overall, if you are creating this strategy, the expected profit you are going to get is 1,500 rupees per day is the profit you will get in average. Some days you make 3,000 rupees, you make 4,000 rupees, some days you make 1,000 rupees loss. So that is expected. So out of 20 days, the profit you are going to make is the 30,000 rupees is the profit you are going to make in monthly. Okay, and the margin you had spent is, let me put is this one as a maximum of 3L. Okay, sometimes it is 2.5L, sometimes it is 3L. So let me put the margin as a 3L. Okay, and the drawdown Okay. So the drawdown, let me put this one as a drawdown. Drawdown of, let me put a high number so that actually, let's put the drawdown is 50K. In worst of worst cases, you are losing 50K. Okay. But guys, this one, let me put for calculation 2.5L. Okay. So 2.5L actually, this is 50K is the max loss. But if you are running, as I said before, don't run this as a full capital. If you have 50L capital, okay, your capital is 50L. Sorry, if your capital is 5 lakhs, deploy only 50%. Deploy only 50%. How I do my capital? How I do? If I have 10L, I do only 25%. Which means that for every 10L, I do only one. So it is as per the risk you are taking. For 10L, what is the drawdown? The drawdown is 50K, the drawdown is 50K. So if you are putting this one for the drawdown in terms of percentage, right? So the drawdown comes to 25%. If you're deploying full, the drawdown is 25%. If you're deploying only 50%, the drawdown is 12.5. If you're deploying only 20, sorry, if you're deploying 50%, the drawdown is 12.5. If you're deploying only 25% of your capital, then it is going to be 6.25%. So it is depends on your risk appetite. If you are, I go with this one because as I said before, any option selling strategy in weekly, you are not supposed to take full margin overnight. The risk is going to be too high, but at the same time, the reward is also too high. But guys, keep in mind that with the 25% margin, you are deployed. What is the profit you are getting? 30,000. It is 3% on the capital. Very important, guys. This many people do not understand. So you are for the 10 lakhs, you are deploying only 2.5 lakhs. Okay, and the return you are getting is a 30,000. So for this capital, it may be close to 12% on margin. So the return by on margin is 12%, and ROI on capital is going to be 3%. If you are doing this one 25% margin. If you are looking for higher return, then put this one as a 50% margin. If you put 50% margin, how much ROI you will get per month? 6% ROI you will get. So the risk, the risk is actually close to 50,000 per one butterfly. Okay, so that is the risk you are going to take. Okay, and then that the max. I'm not saying 50,000 you will lose tomorrow. Okay, so at the max, maybe the series of loss, there is a black swan event you are not able to control. Okay, most of the time the loss is going to be 2,000 rupees, 3,000 rupees, 4,000 rupees. Let me push this drawdown is a 50K for 2.5 lakhs. Okay, so 50K is for 2.5 lakhs, it is going to be 25%. Okay, so not going to use the exact total amount into butterfly. If you use only 50%, then you are going to get a 12.5% drawdown, and the capital and the return you are going to get as a 6%. So my choice is actually put your 25% of your capital into this butterfly. The best thing is for your capital you are getting 3%. What else you need, guys? So weekly, any option butterfly strategy, any strategy, it could be butterfly, it could be iron condor, the return is very high, so your position size should be light, either 50% or 25%. If it is if you are a conservative person, then go with the 25%. If you are really aggressive, then go for 50%, and never ever go for with the full capital. Never ever deploy your capital full in a butterfly strategy. It is not advisable for overnight. Not only for butterfly, any weekly option strategy, it is not advisable. So that's it, guys. The position size should be, so one butterfly, the margin is going to be 2.5 lakhs. Sometimes it may be 3 lakhs. Having 10 lakhs, if you are conservative, with the 10 lakhs, you do only one lot. If you are really aggressive with the 5 lakhs, you do only one lot. If you are super duper aggressive, then you may try with the 2.5 lakhs. Now, then in such a cases, you are going to get 10% return per month. So according to your risk appetite, you are going to do it. So that's it, guys. And with that one, actually, I'm okay with the risk management. So we know the drawdown, we know the risk. If you need a higher return, then you need to accept the higher drawdown. So guys, let me come to the question part right now. Don't do this one on Thursday night. So Thursday nights there is no decay, so avoid that Thursday night. So back testing, I have done it for 5 years, guys. So why don't you do it in Thursday? Because Thursday is there is no decay. This can be done with Nifty. I do with the bank Nifty. This can be done with Nifty. This is not positional strategy. This is a positional strategy because you are carrying overnight. So same thing can be done with Nifty. Yes. How to handle option slippages? You need to go with the option software if you need. If it is a bearish call butterfly, you need to. Yes. Deploying 50% on the margin for Thursday. If you are running for see, some people are asking the question: can I run these strategies for entire say for example, I'm creating this strategy on Monday and then keeping the strategies throughout the expiry? I would say that no. If you're keeping this strategy throughout this expiry, then you may go the higher drawdown. The edge is actually only overnight decay you're trying to capture. That's it. Okay, so if you're keeping this one, if there is a big trend in the market, then you're going to lose. So I would advise no, never ever keep this strategy till the expiry. It is not advisable. Which broker? You can contact my team about the broker and all these things. If you have any question about broker and sensible, you can always contact my team. They can help you out with this one. So because the premium is, it works with all type of wicks. It works with all type of wicks, so you don't need to worry about wicks is high or low. I should do this. Okay, so Thursday we should not do. So Friday, Monday, Tuesday, Wednesday you can do. Only for expiry day you should avoid. Yeah, no, Thursday you should avoid. Thursday 320, never ever take the strategy for the next week because there is not much decay. Friday you can take because 3 days overnight, right? So there is a decay. So that's it, guy. What is the max DD in a back testing? As I said, 50,000. Yes. When we should book a loss, no profit, no loss. So what we are going to do? Next day morning, you are going to exit your trade at 9:20. Whether you are in profit, whether you are in loss, you are going to exit full. That's it. Select all and exit. There is no adjustment. There is no need to worry about all these things. So I do these strategies left and right, guys. This I had been doing since start of my career. So it's a special kind of butterfly. This to exploit the margin only for overnight because I predominantly into the intraday, and that is the reason why I do this strategy. So if you look at my screenshot, right? So in Twitter, you will come to know how I exploit this margin, how I exploit this decay safely with the risk defined manner. So you will come to know. This will give a fantastic return, guys. So that's it. Let me rephrase the one so that you will come to know, you'll get a better idea. So agenda we already said. So let me come to this F&O. So this one I said actually. Okay. So what is the edge? There is a edge is the decay. So that is the reason why we are going to do. Okay. So and myth, it is not true because you see with the 25% of the capital, with the 25% of the capital, you are getting 3% return per month. So the return is too high. So then you may ask a question, can I put full margin and make 12% return? So if you put full margin, the drawdown is going to be huge. In option selling, you should deploy only less and you should make the return for your entire capital. Okay, so you don't need any special software. You always talk with the premium. Okay, so we always talk with standard deviation. Standard deviation is derived from the premium again, or the money called arithmetic. Okay, so this one F1 data analysis we talked. We should analyze 3 parameter: future positions, max pain, and put call ratio. So on a weightage, right? So we are going to form a view. So right now our view is range bound. If the market is bullish, then the future, say for example, future is saying market is bullish and max pain is saying market is bearish. We always go with the future because the future is the master. So these 3 parameters are good enough to take a market view, and based on which you are going to create a butterfly. We are given a live example. So right now the market is bullish, so we are going to get a put butterfly or bear call butterfly. Market is range bound, we are going to create a double butterfly. So most of the time we are going to create a double butterfly. If you are a directional, instead of selling a put, we are doing a put butterfly. Instead of selling a call, we are creating a call butterfly. Very simple method only. So next, so it is a STBT strategy, sell today, buy tomorrow, unorthodox butterfly, and your margin is free. And the ratio is going to be 1 is to n is to n. As I said, it is a net buy strategy. It's going to be 1 is to 5 is to 5 or 1 is to 6 is to 6. And enter today and exit by tomorrow morning. And you will make a huge, huge profit. And never ever deploy the full capital. That is the key and secret sauce in the strategy. If you're deploying full capital, the loss is going to be huge. The profit is also going to be huge. So weekly butterfly, the idea is buy options where the decay is slower, sell options where the decay is faster. Okay, so decay is higher. So creating a butterfly either in a call or put, I had given example in a Excel sheet. Buy off SD in the money option. It could be a call, it could be a put, or it could be a double butterfly. SD is nothing but the sum of call option and put option. Very simple. And sell OTM option at 1 SD. Buy for SD, it is 0.5 SD. So the ratio you are going to try with 1 is to 4 is to 4, 1 is to 5 is to 5, 1 is to 6 is to 6. Which one is coming close to no debit or no credit? That is the one you are trying to exploit. So that is the one. And the premiums. So we are buying options where the decay is less. We are selling options where the decay is higher. So example I had given, this is a real-time example also I had given. Buy in the money put and sell OTM puts and buy out of the money put. You need to always net long, because if there is a black swan event, you are not going to make unlimited loss, rather than you will make a profit. So always, because you are buying at 2.5 SD. Okay, so the far OTM, this one will not decay faster in black span event, right? So in black span event only, market will move more than 2.5 SD. In such a cases, you are going to make a pada profit. So this put butterfly, you can make it net long. Call, you don't need to make a net long. You can create 1 is to 5 is to 4. But put, always make sure that you have an extra buy. Very important. Okay. So it should be no credit or no debit. So that is the strategies you should do. And live example also I had shown, and the risk management also I talked, and the position sizing I said. So position sizing, never ever deploy full capital. So deploy only 25% or 50% is the max. So never deploy 100%. It is not advisable. So not only with this butterfly strategy, any weekly strategies you are not supposed to deploy full. So close to 3% return you can get with the 25% margin, 50% margin if you putting, then you are going to get a 6% margin. So one butterfly, the drawdown will make go to 50,000. Yeah. Guys, with that, actually, I'm done with my presentation. So let me come to the question part to answer. I know that it is not easy to grasp everything in one session. You have a recorded session, you can always ask. And if you have any questions, and never mind, actually, you can always send a query to us. I'll always reply. And don't worry about if your question is not being answered. So what is the market view in creating a butterfly strategy? Why market view is important? Because you make your, I mean, if you're making STPT, always I mean, market view is very important, because you make more profit with the market directions. So that is the point. So when we have to do the deploy the iron condor, I am not a big fan of iron condor. Iron condor, both in weekly as well as in monthly, I am not a big fan of iron condor, because chota profit and pada loss with iron condor, which I can use this one as the intraday strategies. I don't think so. Intraday, it is not a great strategy. This is only will work for in gap down. As I said, what is the loss in gap down? Exactly, it gaps down at 1 SD, then you will make a max loss. Okay, so otherwise you don't make a big loss at all. So if it gaps down exactly 1 SD, you will make a big loss, maybe 25,000 or 30,000. No, when it reaches 1 SD, you are getting loss close to 11,000 or 12,000. When it gaps down more than 2 SD, you make a big loss. But if it gaps down and then it bleeds, then you're going to make a profit. So So today the recording should be available. Then you can contact with the eLearn Market. I hope this is. I don't know how the session was. You can put your feedback and comments here as to how the session is. And I will not have a time to answer all these queries. You can always put your later through eLearn Market or directly to me. So thanks, guys. And Swati or Vivek, you can come back and then.
Yes.
Yeah.
So, thank you, Jagan. Thank you so much for being connected with us for this particular webinar. Thank you so very much. And thank you even for accepting this invitation and making this session super, super effective for all my listeners.
Right.
Thank you. Lina. I believe you have loved the session of Jagan and will definitely get Jagan for such more session, great session in future for sure. Um, so yes, the Jagan have done this session. Of course, this was a live session, and the recording of this session, along with the presentation, we're going to upload at elanmarkets.com. So how you can access that is you have to simply log into elanmarkets.com. Under your account, you will find my webinar section. Right there, the recording and the presentation will be available by tonight 8 p.m. Also remember that the recording of the session is accessible to all of you for lifetime, right? So do not worry about it. And at any, if we have missed out any of a query, please do not worry. Do not hesitate to put your question to us at support@elanmarkets.com. We will compile all the questions together and then we will send it across to Jagan's team maybe by Wednesday. After Wednesday, of course, we will not be taking any further question. So please, if you have any question, go through the recording today, tomorrow, day after, and send us the query if you have any. And when we send the query to Jagan, another 3 days later, we will give you the answer for sure. All right, because he keeps on busy with some other work also. His projects are there, a lot of things are there which he needs to look at. So thank you, Jagan. Thank you so much for being with us on eLearn Markets. Thank you very much.
Thank you, thank you. And most people will have questions about this Excel sheet because I'm doing a lot of calculation, right? So simple calculation. So you will have the queries mostly in this Excel calculation only. So you have a recording session, you can always get connected with the recording section. So you will come to know. I mean, this session for new beginners, it will be tough to understand in single shot. So you can always view the recording once so that you will come to know the full understanding. So.
So Jagan, I have another question related to the Excel file. So do you
Right.
want the listeners to go through the recording and through which they will follow the Excel, or you're going to share the Excel file with us?
No, they can view the recording. That is better because I deleted everything. Yeah.
Okay, no problem. All right. Thank you, Jagan. Thank you so much.
Yeah. Okay.